Good morning and welcome to the Invicta Holdings Limited Interim Results webinar for the 6 months ended 30 September 2025. Thank you for joining us today. The management team will take you through the presentation and you will have the opportunity to submit your questions using the question function on your screen. After the presentation concludes, I'll share your questions with the panelists for discussion. It is now my pleasure to hand you over to Stephen Joffe.
Welcome to all of you, and thank you for joining us. I am Stephen Joffe, the Chief Executive Officer of Invicta, and I'm joined by our Chief Financial Officer, Nazir Raj Mohammed. Craig Barnard is also available as part of our panel to answer any questions you may have. During this presentation, in respect of any commentary or views we may portray, and to the extent we analyse information, or make forward-looking statements, please have regards to our disclaimer. Today's presentation will cover our group results for the interim period ended 30 September 2025. We will also attempt to cover key developments from the period, as well as looking forward to the prospects and strategies of the group. Invicta distributes world-leading capital and earth-moving equipment, industrial, automotive and agricultural parts, often exclusively, which we try to ensure are always available and that are overlaid with a technical and service solution. We thus differentiate ourselves by adding value through our distribution chain, product availability and by providing technical support. Technical support helps prevent disintermediation and is a key part of our strategy to add value to our customers. Invicta is pleased to present a solid set of results for the first half of the year, notwithstanding the tough trading conditions that we've experienced across the businesses. In the first half of this year, we worked hard on streamlining our operations, bedding down investments, and keeping abreast of tariffs and foreign exchange fluctuations. In the prior year, we made great strides by disposing of the main distribution warehouse in the Keenan operations in Singapore and using some of those proceeds to redeem all of the outstanding preference shares. These initiatives are starting to yield results in the current year. The strength of our operational model and the strategic initiatives have allowed us to maintain stability and growth in the businesses in the face of challenging operational environments. We remain confident in the strength of our businesses and the long-term value we aim to deliver to shareholders. We continue to focus on executing our strategy, driving operational efficiency, and position ourselves for sustainable growth. We believe that our strategy of investing offshore in our markets will, over the long term, deliver the return we endeavour to obtain for our shareholders. Through the first 6 months, many central banks have continued cutting the interest rates to stimulate activity. In South Africa, we saw 2 interest rate cuts during the period, and we hope that the cuts will continue as interest rates remain high amidst a low-growth industrial environment. Throughout the period, we experienced extreme volatility in currencies. We opened the period with a rand-dollar rate of 18.31 rand. The rate peaked at 19.77 rand and closed at 17.26 rand on 30 September. Mining and manufacturing activities continued to struggle during the period, specifically with the PGMs and iron ore facing declining demand. Over the period, we've seen growth in these sectors. However, they're coming off a low base and will still have a long way to go to return to continuous production. In certain sectors, we have seen the local market exhibiting increased activity levels, which have remained at these levels. The industrial sector in South Africa remains a challenging environment in which to operate, with the regulatory environment doing little to stimulate growth in the sector. Also, our businesses continue to experience supply chain challenges, including delays at the port. Container prices out of China have remained volatile, with prices oscillating between $2,500 to $4,200 for 40-foot containers. Notable achievements for the first half of the year, notwithstanding the challenging environment, include growing sustainable headline earnings per share by 19% to 285 cents. Through the strategic initiatives undertaken in the prior year, we achieved a 14% reduction in net finance costs for the period, which in the current period amounts to 54 million rand. And we successfully concluded the acquisition of Spalding's operations in the UK on the 1st of September, which I will speak to more later in the presentation. Group Financial Overview. Sustainable operating profit was down 6% on the prior comparative period, amounting to 332 million rand. This is reflective of the tough conditions in the market in which we operate, as well as the cost-based details, which we'll unpack later in the presentation. In determining sustainable operating profits, we have made the following adjustments. In both the current and the prior year, we reversed profits made on the disposal of non-core properties, as well as impairments on those properties when they were reclassified as held for sale. We also reversed profits made on the disposal of subsidiaries. We added back amortization of the PPA assets of NWB and Spaldings. In the current year, we added back once-off costs related to the acquisition of the Spaldings Group in September, and we unwound a modification loss, which is a time value of money accounting adjustment on the amounts owed to the group by the KMP operations. Equity accounting earnings from the K&N investment decreased year on year by 10% to 77 million. The result from K&N have been impacted by the US tariffs, which has created uncertainty in the market. Customers had reservations in purchasing amid the uncertain tariff positions. Additionally, the translated foreign currency results have been dampened with the strengthening of the rand over the period. In determining our share of sustainable net contribution from the K&N Group, we added back the amortization of the purchase price allocation assets amounting to 8 million rand. Sustainable headline earnings increased by 9%. In determining our sustainable headline earnings, we added back the amortization of the PPA assets. We unwound a time value of money adjustment on an amount owing from KMP to the group and added back once-off costs relating to the acquisition of the Spaldings operations. Please have a look at our key indicators. Where appropriate, they've been adjusted for once-off items to try present a position showing sustainable earnings. Operating profit was 6% lower than the prior period. Headline earnings per share grew by 19% to 285 cents. Our net asset value per share of 60 rand and 90 cents was 3% higher than 31 March 2025. No adjustment has been made to the net asset value calculation. I will now hand over to Natalie.
Revenue for the 6 months increased 6% from the prior comparative period. As a key management initiative, the gross profit percentage has been maintained at 32%. In the current environment, maintaining this margin is a great achievement by the management teams. Operating expenses, as reported, grew by 11% compared with the comparative period. There are several factors that contributed to this increase. Firstly, the comparative expense line was reduced by 17 million rands of gains on disposals of properties and subsidiaries, compared with only 4 million rands in the current reporting period. The current period includes once-off costs relating to the acquisition of the Spaldings operations, whose 1 month of operating expenses were also included in the current period for the first time. Therefore, in normalizing all of these items, we experienced a 6% increase in our overhead base. Operating profit before foreign exchange movements for the first half of the year was 12% lower than the comparative period. This highlights the tough trading conditions which the group faces, as well as the once-off items which Stephen has already mentioned, and we thank our management teams for maintaining relative stability in our operations. Comparing the opening and closing rates over the first 6 months, the rand did strengthen. Against the US dollar, the rand appreciated 5.7% from 18.31 on the 1st of April to 17.26 on the 30th September. However, throughout the half, we saw much volatility in the currency, with the rand depreciating as low as 19.77 to the dollar. The impact on our group for the first half of the year was a net forex loss of 16 million rands, which is a 9% improvement on the 18 million rands in the prior period. As a matter of policy, in South Africa, we hedge all confirmed foreign purchase orders. Net finance cost decreased by 9 million rands due to the strategic initiatives undertaken in the prior year. During the period, the South African Reserve Bank decreased the prime interest rate by 50 basis points through a stepped approach to 10.5%. We welcome these adjustments from the SARB, and we hope to see continued cuts in the future. Ordinary shareholders are better off by not having to pay dividends to preference shareholders versus the comparative of 24 million rands in dividends. Property, plant and equipment increased by 93 million rands. This is primarily driven by the acquisition of the Spaldings operations in the UK. Investment in joint ventures is our 48.8% investment in Keenan. The decrease over the reporting period is made up of 69 million rands of equity accounted earnings, less 18 million rands of our share in the other comprehensive losses of the Keenan operations, as well as 39 million rands of foreign currency translation and dividends declared of 44 million rands. Goodwill increased by 70 million rands. This is the goodwill recognized on the Spaldings acquisition, net of the foreign exchange adjustment from the strengthening of the rand. Finance lease receivables, including the current portion, increased from 384 million rands to 412 million rands. This is finance extended to customers across our capital equipment businesses. This finance is both short and long-term in nature. We remain focused on working capital management. Inventories net of provisions remained flat for the period. Considering the addition of the inventory of the Spaldings business, management have worked hard on reducing the inventory held and ensured that they are covering foreign exchange risks in their purchases. Gross inventories decreased by 82 million rands in our industrial solutions businesses. The management team have done a great job in purchasing correctly and selling older inventory over the period. The net increase in the capital equipment and parts operations was as a result of the Spaldings acquisition in September. Our management teams continue to focus on the number of months of inventory held. We continue to manage as best as we can the volatility in currencies, logistic costs, and inflationary pressures in our basket of products. Our continued focus on ordering the correct inventory and selling aged inventory has helped to keep this number in check. Trade and other receivables increased by 14 million rands. We continue to see across our businesses that the debtor insurance levels and criteria continue to tighten. We continue to focus on giving appropriate credit and ensuring the collectability of our receivables. Please note our cash on hand of 931 million rands. Our borrowings and finance lease liabilities amounted to 1.91 billion rands, of which 1.53 billion is non-current and 375 million rands is current. Of the total borrowings, finance lease liabilities make up 365 million rands. With our cash on hand of 931 million rands and our overdraft of 30 million rands, we have net cash on hand of 901 million rands. Our net interest-bearing debt is thus a billion rands. The equivalent number in March 2025 was 706 million rands. This increase is mostly as a result of the Spaldings acquisition in September. Please note that the 1 billion rands exclude the IFRS 16 liabilities of 252 million. Including IFRS 16, net interest-bearing debt for the year increased by 297 million rands. Our net interest-bearing debt to equity sits at a healthy 23%. Please see a summary of our banking covenants, all of which have been met at half year. We were pleased to generate 419 million rands in cash from operations, a 26% improvement over the comparative 6 months. We also continued the expansion of the group through the acquisition of the Spaldings Group of companies. We received 44 million rands of dividends from Keenan. Please note the 97 million rands distributed to shareholders as we repurchased 3.1 million ordinary shares in April. We have, therefore, in aggregate of buybacks and dividends, returned in excess of 200 million rands to shareholders in the first 6 months of the year. We are pleased with the net closing cash balance of 901 million rands, which is after all of the activities detailed above. I now hand back to Stephen.
Thank you, Nazli. Operational review. Previously, we presented the Invicta results across 5 segments in our biannual presentations. Following engagement with investors, and as part of the process to assist users of our presentation, we have moved to simplify our presentation and reduce the number of operations presented. Reducing the number of operations presented will ensure the underlying performance is easier for stakeholders to understand, particularly as the 5 segments have overlapping or less clearly defined differences. This consolidation aligns the presentation more closely with how management views the risk pertaining to the businesses without overwhelming users with excessive detail. Going forward, the businesses will be presented in 2 operations. The operations are Industrial Solutions and Parts, Capital Equipment and Parts. The Industrial Solutions and Parts operation will in aggregate comprise what used to be presented as the RPI and RPA segments. The Capital Equipment and Parts operation would in aggregate present what used to be in the CE and RPE segments, as well as that of Keenan in Singapore. Industrial Solutions and Parts. These business includes our BMG businesses, our UPG automotive businesses, amongst others. Revenue has remained relatively flat year on year, with the management doing well to sustain these levels under the current market conditions. Sustainable operating profit in these operations decreased by 11%. This is primarily as a result of certain costs incurred in the first 6 months of the year, which were budgeted to be incurred over the full financial year. We anticipate clawing back on these costs in the second half of the year to conclude the year on a normal increase in the cost base. Net operating assets increased to 2.5 billion rand. The return on net operating assets weakened slightly from 19% to 18%. Please see how we determined sustainable profits for the purpose of determining our returns. Automotive and transport, mining, and retail trade remain the top sectors for us across our industrial businesses. The teams have worked hard to maintain sales amidst a deindustrialization in South Africa. Roughly 2/3 of our sales come from consumable parts, and our industrial businesses primarily operate in South Africa, with offshore markets becoming more important over time as we focus on the internationalization of these operations. The industrial sector in South Africa continues to face pressures from all sides, and we anticipate a dampening of demand for products as a knock-on effect from other struggling businesses. This in turn impacts margins as the market competes for business. However, our engineering services businesses continues to do well. We have seen positive movements in the automotive business in South Africa, and we're optimistic about the growth in our agricultural house brands locally. With the sustained tensions in Eastern Europe, we continue seeking to expand our auto agri businesses westward into other European geographies. Capital equipment and parts. These operations consist of our capital equipment businesses, the K&N operation in Singapore, as well as the newly acquired Spaldings in the United Kingdom, amongst others. Revenue for these operations was 25% higher than the prior period. This growth is primarily attributable to improved performance across the capital equipment businesses in the first 6 months, as we saw increased volumes in the construction and mining sectors. 2023 is, however, not comparable, as this includes the KMP operations that were disposed of to the K&N Group. Sustainable operating profit improved by 7% to 214 million rand. This improvement was due to management's ability to contain costs across our businesses. Net operating assets increased by 330 million rand, primarily driven by the inclusion of the Spalding assets. Following this inclusion, the return on net operating assets slipped from 15.7% to 14.5%, with only 1 month of trading from Spaldings consolidated with the full balance sheet. Please see how we determine sustainable operating profit for the purpose of determining our returns. Construction, material handling, and agriculture are the largest industries we service in our capital equipment and parts businesses. We have done well in ensuring roughly half of our business comes from equipment and the balance from parts in these businesses. Revenue comes primarily from South Africa. This graph does not account for sales in the K&N business, which is equity accounted, bringing in only the profit from our share of the joint venture. In South Africa, we are starting to see growth in the construction and mining markets, with volumes starting to increase. This improvement in the mining sector is positive. However, this comes off a low base, and the sector still has a long way to go to return to full production. We are positive that we've come to a more stable position in terms of global tariffs, and we hope this will provide the impetus for a global sales improvement. Key developments and transactions. On the 1st of May 2025, K&N acquired 100% of Safe Harbor. Safe Harbor is a premium aftermarket parts supplier, primarily of cab glass, for a wide variety of capital equipment. Safe Harbor operates from a single premises in Texas, United States. We are also pleased to advise that on the 1st of September 2025, Invicta purchased the Spaldings operation. Spalding is a prominent distributor of agricultural and ground care components in the UK, known for its extensive range of high-quality replacement parts and machinery. Established in 1954 and headquartered in Lincolnshire, Spalding has built a strong reputation over more than 70 years for innovation, quality, and strong customer service. We paid £10.5 million for the Spalding shares and anticipate the sustainable aggregate net profit for the first full year should be in the region of £1.4 to £1.6 million. Most of this profit will be earned in the UK summer and won't have any meaningful impact on the next 6 months for Invicta. In April, we were further able to repurchase a significant tranche of Invicta shares, roughly 3.1 million shares, thereby returning a further 97 million rand to shareholders. Prospects and strategy. 5 years ago, we set out to grow the group into a geographical and sectoral diversified group. With our acquisitions and corporate initiatives undertaken over this period, we believe we have already achieved this goal. Going forward, we have a relatively debt-free balance sheet and the freedom to scale our platform and add meaningful acquisitions. Our management teams continue to manage our businesses well to ensure it achieves the desired returns. Our objectives for the second half of the year include managing working capital and optimizing operations, generating cash, managing the supply chain and logistical challenges, looking for appropriate acquisitions, and new product lines for our existing businesses. With the fluctuations of tariffs globally, future economic outlook remains difficult to gauge. We are working hard to remain well informed on the developments and hope to move as quickly as possible to assess and deal with them promptly, ensuring the businesses remain stable. With so much uncertainty in the world, we will continue to focus on cash generation. Having a relatively debt-free business gives us the necessary time to respond to difficult situations, at the same time provides the capacity for us to implement our acquisition strategy. We are evaluating several opportunities on the acquisition front, and should we be able to identify suitable targets that align with our strategy, we will certainly continue to acquire businesses. As a result of our relative financial strength, we'll endeavour to return to shareholders approximately 30% of our earnings annually, be it either through buybacks in the market or dividends. Many of the sectors we serve are trading in line with these results, and we continue to service our clients without stockouts or delays. We're extremely grateful to have delivered this performance for our shareholders and our other stakeholders in the midst of tough trading conditions. Thank you to our loyal suppliers, customers, and advisors for your continued partnership with the group. Our experienced, diligent, and dedicated teams, from the factory floors to the boardrooms, we thank you for your efforts in the first half of this year. Lastly, we wish to thank the Chairman and the non-executives for their continued guidance and advice.